What is going on, team, and welcome back to another video. In this video, I will be going over ICT market structure and how I view the market, certain things it does when it's bullish, certain things it does when it's bearish, and kind of just a video on how to identify order flow, because that is without a doubt one of the most important things to pay attention to when you're trading. So hopefully I can help some of you out with this video. Okay, so the first thing that we're going to be talking about is what we call intermediate term highs and intermediate term lows. Now right here, we have a perfect example of an intermediate term high. Basically, all that this means is that you'll have a swing high that filled an imbalance. That is what we call an intermediate term high, right? ITH for short. So this right here would be an intermediate term high because it is a high that filled an imbalance, and it is a swing high, meaning that this high is higher than this high right next to it, and this high is also higher than the candle next to it, right? That is what a swing high is, right? And that is needed in order for an intermediate term high to form. A swing high that fills an imbalance. Now, how we use these, or how I use them, is that if you are truly bearish, these highs should not be broken. So these are some of the best places to place your stop loss or trail your stop loss. And it is very important when you look at market structure. So let's have a look at a few examples on an actual chart. Now, a general rule that I use with these intermediate term highs and intermediate term lows is that it just has to fill 80 to 100% of the gap. So right here, we have a perfect example, right? This is something that I would identify as an intermediate term high. I know it didn't fill it, but it probably filled 95% of this whole gap, right? So this, in my opinion, is an intermediate term high. It is a swing high inside an imbalance that almost filled it, and it has a lower high next to it and another lower high next to it, right? And so if we are truly bearish, this high should indeed hold. And it also did, right? Now we're starting to kind of reverse down here. Again, right here is a great example of an intermediate term low, right? We have a huge rally up, and we have an imbalance right here that is then filled by this candle. And the next candle is not lower than this low. Therefore, this is a swing low, and therefore it is an intermediate term low. So that is not a bad spot to go along, if you're asking me, because if you are truly bullish, this low should hold. Of course, the higher time frame, the better, and the more accurate it will be. But if we go to 1 to 2 here, and we have our stop at that low, because again, it should hold, and we play it out, it plays out very, very beautiful, right? So we have that intermediate term low. We put our stop there, because if we hit this low, then we are probably not bullish, and we don't want to be in the trade any longer. Again, we see it right here. We have an imbalance here. Price comes down, fills that imbalance, and then creates a swing low. And this is what we call an intermediate term low, right? Probably the best spot to place your stop. As you can see, we had a huge rally, and this low wasn't taken out until right here. And the reason that this happens is because if a market is in a rally, rebalances like this are necessary, okay? The market will often be very bullish and then have a retracement just to rebalance to then go higher, which is exactly what happened here, right? We have that rally up, we come down, we rebalance, we come back up, come back down, we rebalance, we see it again right here. We have a fair value gap here that got filled by this candle. This low becomes an intermediate term low. We see it again right here. We have an imbalance. We have a swing low, and that low now becomes an intermediate term low. We see it again right here. We come down. There's a gap here that we fill, and then that swing low that was created now becomes an intermediate term low. And if we are truly bullish, we can expect this to hold. And it certainly did. So these moves are necessary for price to do during a rally, up or down, because it needs to rebalance before going higher or going lower. We see it again right here. We have a huge rally up. We have a swing low that fills this imbalance. We have another great example here. We have a rally up. very, very bullish displacement. Then we have a candle that rebalances a fair value gap right here. It comes down, it fills that fair value gap, and it closes back inside. That is something you want to pay attention to. If it closes back inside, that makes the intermediate term low higher probability. That is exactly what it does here. So if we went along straight off of this, we could go along here. But if you want to make it higher probability, you want to wait for this to become an order block, meaning that we get a candle closure above here. Let's see what happens. The next candle does close above it. So we can either go long here if we don't feel like there will be a retracement, or we can go long straight from the order block and put our stop at the intermediate term low. Because again, we are expecting price to be bullish, so we want to see this low hold. Now we'll target a 1 to 2, and then we'll let it play out and see what happens. So we come down, and a lot of people may be stressing, but remember, we put our stop loss here for a reason. And as you can see, the low held. And the next thing that we're going to be talking about is what we call an immediate rebalance. We'll see it right here. Price comes down, fills this right here, making sure that we can't create a fair value gap here, right? That is what we call an immediate rebalance. When price comes down, right, make sure that we can't create a fair value gap, meaning that it rebalances before the fair value gap is even created and then continues higher. We see it right here, right? That is something we like to see. So if we are bullish and we see an immediate rebalance, meaning that we come down, right? We make sure that we cannot create a fair value gap here, meaning that we immediately rebalance without creating a gap and then closes higher. That is what we call an immediate rebalance, and that is something that we want to see if we are bullish. Let's say we were still in that trade from earlier, that order block trade, right? But our target was higher. This immediate rebalance is something that I really like to see because that supports our bullish idea. When you get immediate rebalances like this and then a higher closure, that is something that we really want to see and something that often happens if the order flow is right. Now this right here is also an immediate rebalance in my opinion. If you pay close attention, there is a really small fair value gap. But in my opinion, this is also an immediate rebalance and something that I want to see. And you can, if you are really confident about the drawn liquidity, you can actually enter on the wick. So our entry could be here. Now in this case, we would not have gotten filled, but you can enter on the wick of the previous candle, and then you are entering off of that immediate rebalance. So right here, we have a lot of bullish displacement. If we were really confident that we were going to go higher, we could put our stop below here, and our entry would be this wick, because if price comes down here before creating the third candle of the fair value gap, then this would be an immediate rebalance, right? This next candle has to fill us, because then that becomes an immediate rebalance, and if our drawn liquidity is right, then that should really hold, right? So we'll go for a 1 to 2, and our entry will be this wick for the immediate rebalance. Then we play it out, and it works beautifully, right? We come down, we have that immediate rebalance, then we move higher. We see it right after again, right? We have a candle here and here, then this candle immediately rebalances and moves higher. Now the next thing that we're going to talk about is what we call breakaway gaps. Now some people like these and some people don't. I'm personally a bit in the middle. I find them useful sometimes, and other times, you know, they kind of don't make sense or are kind of useless. But what a breakaway gap really is that it is a gap that never gets traded back into, right? So as you can see, this would be a breakaway gap, and this right here would be a breakaway gap, and this right here would also be a breakaway gap. But technically, we can only call it a breakaway gap after price has done its move, right? But one way that we can anticipate these breakaway gaps is if we have, or we create a big gap like this, and then we create another big gap like this, I can therefore assume that this now is a breakaway gap because we have this much displacement. We have a low here that we displace below, right? This is significant closure below this low. So we have a bigger gap here that obviously never got traded back into. Then we create another gap that never gets traded back into. So now we have two gaps, right? So after this gets created, this is now what I anticipate to be a breakaway gap. Now, we then create another gap here. Once this is created with the same displacement, I can now assume that this is a breakaway gap. Then we displace even lower and create another one, right? If my drawn liquidity is still lower, I can therefore assume that this is a breakaway gap. So let's go back in replay mode and let me show you exactly what I mean. So we get the first displacement candle. We get the second displacement candle that also closes significantly below this low. So now we have one forex gap. I need one more candle closure in order for another one to form. Right now, I cannot anticipate that this is going to be a breakaway gap. Now we have two forex gaps. So because we created another one with the same displacement, I can now assume that this one up here is going to be a breakaway gap, but not this one yet. I need one more gap in order for me to believe that this can potentially be a breakaway gap. Then we get another gap with the same displacement. Now this is kind of dangerous because it swept the low and it didn't really close below that low. That is what we would want to see. If price had closed down here, then this gap right here would make this a very valid breakaway gap. But the point of breakaway gaps, or at least the way ICT uses them, is for his stop loss placement, right? Or to identify displacement. So we have a lot of gaps here with a lot of displacement. So because we have so many unfilled gaps that never got traded back into, that probably means that the drawn liquidity is even lower, especially if the first one that we hit is holding, right? So the first gap that we hit right here, if that continues to hold like it does right here, then the drawn liquidity is probably lower, right? If we start to displace through this and maybe through this, then I'm not confident that these two are gonna hold. So as you can probably hear, it's really a personal preference or opinion regarding these breakaway gaps. Some people like them, some people use them a lot. Other people don't even pay attention to them, which I completely understand both sides. So I figured I would just let you know exactly what they were in case you hear it anywhere or see it annotated on ICT's chart. So whenever ICT has a breakaway gap annotated, that means that he does not expect price to retrace back into that forex gap. And he will often put his stop loss there because if it does retrace into that breakaway gap, he probably don't want to be in the trade anymore. Now, the next thing that I want to talk about is holding PD arrays versus not holding PD arrays. Okay. This is probably the #1 tip that I could give anyone when looking to identify order flow. So if we look at this sell side curve over here, we can see that we have this gap here that price hits, then rallies down. We create another gap here that price hits, then rallies down. So in other words, at this moment in time, we are holding bearish PD arrays. And if we look all the way to the left over here, we are probably violating a lot of bullish PD arrays, right? So what do I want to see now in order for me to believe that we are switching from bearish order flow to bullish order flow? I want to see these bearish PD arrays fail to hold, meaning that we close above them, right? So I want to see bullish PD arrays start to hold and bearish one starts to fail. So let's see what happens here, right? The first gap here, big gap, gets violated. Now let's see how we treat this gap here. Already, we are holding this very nicely so far. So we went from holding bearish PD arrays very nicely to violating bearish PD arrays and now holding bullish ones, right? That is how you identify a reversal, in my opinion. Because we violated this and we are now holding this, let's see what we continue to do, right? We are inside another one here. Let's see if we can violate this one. Right, it is extremely beautiful here. Here we have a 3-minute gap that we hit, move higher, we come down a bit, then we move up, we create another gap, another bullish gap here. We closed within that gap, meaning that we're still holding this gap, right? Then we violate this bearish one that we just made, and then we violate another bearish one here to the left, right? So we are now violating a bunch of bearish PD arrays and holding a bunch of bullish ones. So now we can safely assume that the drawn liquidity is probably higher. Now let's see what happens if we went long based off of this inversion fair value gap here. Let's use our intermediate term low analogy that we learned before as our stop loss. And then we'll go for a 1 to 2, or we'll target the end of this gap up here. Let's see what happens. And we just immediately run higher, right? So say we entered on the close of this inversion fair value gap. Beautiful, right? And if we take a look throughout this whole leg, we are still holding bullish PD arrays, and we are still violating these bearish PD arrays out here to the left. And that is the number one tip that I could give anyone when trying to learn ICT market structure or identifying order flow. What PD arrays are we holding and which ones are we violating? Now, the next thing that I want to talk about and that I wrote down is lack of displacement versus successfully displacing, right? So what do I mean by this? Well, right here, we are lacking displacement above this high, right? And we have a swing low down here. So let's see what happens. Not yet, I wouldn't say actually. There we go. We certainly get displacement below that low here, right? And we are lacking to displace above this high. So lack of displacement, successful displacement. Let's see what happens if we play it out. We really just run a lot lower, right? And then we start that rally up. And all of this was identified by simply looking at failing to displace above a high, successfully displacing below a low. Now right here, if you are looking at this, you would have no idea whether we are going to continue to go down or we are going to go up, right? But one way we can identify this is to look whether we displace below this low, because if we displace below this low, probably we're going to go a lot lower. Then we created a swing high here. If we displace above this high, probably we're going to go a lot higher, or at least until this high. If that displacement above this low is combined with the violation of this bearish gap, then that adds to the bullish idea, right? So let's see what happens. Now we obviously fail miserably to displace below this low, and we very successfully displace above this high. So let's say we just entered purely off of this displacement, put our stop at this body here, and then target the opposing liquidity right here. And then let's see what happens. Very, very beautiful, right? Now, when we get another candle closure above this high here, that means we create what we would call a breaker block, right? Which you can see price reacts very nicely to. At the same time, we are holding this bullish gap, and we just violated this bearish one, right? But that is really an entry model, failing to displace below a low, successfully displacing above a high while violating a bearish gap. Therefore, you could safely assume that your drawn liquidity is probably higher. Again, we have obvious bearish order flow, right? Previously, we had a low here that we failed to close below. We move higher, but then we failed to displace above the high here. We move lower, successfully displace below the low here, right? So now, if we want to figure out whether the order flow is going to continue bearish or bullish, we look whether we displace above this high, or this low or this high, right? So let's see what happens. Obviously, we displaced above this high and we failed to displace below this low. So let's say I wanted to enter here just straight off of the displacement. I could. Stop could be this order block right here, and we could target the end of this low resistance liquidity that we have here. So let's see what happens. Again, very, very beautiful. All because we looked for lack of displacement lower and successfully displacing above the high, right? As you can see, previously, we never displaced above any of the highs, right? We failed to displace above the high each time, but the one time that we do displace above the high, we rally, right? So another great way to catch reversals. Also, the last video I made was on the ICT change in state of delivery, which would mean that you could have caught this move early if you watched my video. Okay, so go watch that if you haven't already. Now, the next thing, also a very, very important part of this whole video, is that we immediately create an order block, right? So let's see here. We have a bullish candle, then we have a bearish one. If we want if our drawn liquidity is higher, we would like to see this candle become an order block, meaning that we get a candle closure above here, creating an order block, right? So if this next candle closes above here, creating an order block immediately, that is a very good sign that we're going to go higher. If we take a look, we did indeed close above this, creating an order block. So we can actually enter straight off of that close, especially when it happens with displacement like this. And of course, we know that this is going to win because we did just play it. But that is just to show you that you can catch these moves really early on if you know what to look for. Again, had you missed this entry, we had another one here. We have a bearish candle. The very next candle closes above it, making this an order block, and we rally, right? Now, of course, you don't just want to trade every order block creation you see, right? You want to put it into context by applying all the things that I taught you in this video. So if we take a look at this high here, would you classify this as displacement above this high? Definitely not, right? Would you classify this as displacement above this high? Definitely not, right? So we are failing to displace above this high. Now, what did we do right after? We successfully displaced below this swing low. Now let's see here. What happens? We get an up close candle. Now, because we failed to displace above here, we successfully displaced below here. If this candle now becomes an order block, meaning that we get a bearish candle closure below here, then that is a very, very good sign, right? We do. And what do we do at the same time? We are holding a bearish gap. Another great confluence, right? And again, what are we doing at the same time? We are failing to hold bullish ones, right? There was also this one that we closed below. In case you were confused, the way you identify an invalid fair value gap is that we close below it, right? So this gap got invalidated by this candle. This gap got invalidated by this candle. So again, we're using all the principles that I just taught you. Failing to displace above a high, yes. Failing to hold bullish PD arrays, yes. Successfully holding bearish PD arrays, yes. Successfully displacing below a low, yes. We have an up close candle that immediately gets closed below, meaning that we create an order block, yes. We can go short here, put our stop here, because now we have a gap here and we have another gap here. Therefore, we can what? Assume that this becomes a breakaway gap. We can put our target at this swing low down here, and then let's play it out, right? And by the way, as soon as this closes, what has this now become? An intermediate term high, so we can move our stop to there, right? Because if we're truly bearish, this high should hold. And there we go, very beautiful. The high held, and we applied all the principles which I just taught you. Something quickly that I want to mention is something that ICT calls the three drive pattern. And basically all it is that it is something that smart money uses to trick retail traders into going long, right? So here we have swing high made, we have a high, a new high made, then we have a new high, and then a dump. That is what ICT calls the three drive pattern, okay? Very easy to get tricked by this. It looks very, very bullish until it doesn't. So this is basically how you identify it. High being made, another high, the last high before the dump, right? So you can either use this to, you can trade it, or you can get stopped out by it. So I just figured I quickly wanted to mention that because I could imagine that a lot of people could get messed up by this if they are not aware of that concept. Now, without a doubt, this is probably the most valuable video that I ever put out. And I honestly can't believe that I'm just putting it out for free. So I sincerely hope that you appreciate it. This is really, really how I view the market. And it's honestly crazy that I'm just publishing it for free when people are charging thousands and thousands of dollars for it. But there you go. I hope you enjoyed. Very, 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 very valuable stuff in here. So I really hope you enjoyed, and I will see you in my next video. Bye bye.